Hello and welcome to UW-Madison Division of Extension Farm Ready Research Farm Management Friday program. I'm Tricia Wagner, Outreach Program Manager for our Extension Farm Management Program. I'm joined today by Extension specialists and educators to discuss the topic of FarmGate Economic Outlook, where we will focus our discussion on actions for farms in 2022 based on Farm Scale Economic Outlook. Before we get started, I want to draw your attention to the link in the meeting description on your screen. You may have to hit the See More button to access the links. Here you'll find a link that you can use for our program question and answer. This link to submit any questions or comments you may have for today's speakers, and we'll be sure to bring them to the discussion. I will now introduce Katie Wontak. She's the Dunn County Extension Educator. She's going to begin today's discussion by introducing our Extension Specialist panel. Thanks, Katie. Oops, you're muted.
There we go. All right. Thank you, Tricia, and welcome everyone to today's program. We all know that 2021 was unfortunately another challenging year with COVID crisis, creating some upheavals in the agriculture commodity markets, as well as supply chains. With these uncertain times continuing, we look for some insights on what 2022 will bring us. Today's program, FarmGate Economic Forum, will focus on those farm scale economic outlook and insights from our industry experts here at the UW, as you reevaluate the farm financial situation and decide if and when to make those important decisions on your farm business. Now I have the pleasure of introducing our panelists for today's session. Dr. Paul Mitchell is a professor in the Department of Agriculture and Applied Economics at UW-Madison. Paul is the Extension State Specialist in Cropping Systems Management and is the director of the Rank Agribusiness Institute. Dr. Brenda Botel is professor and department chair of agricultural economics at UW River Falls. Brenda is an extension agricultural marketing specialist focusing in the areas of livestock marketing and price analysis. In addition to her background in agriculture and applied economics, she has an interest in international development. Dr. Mark Stevenson is the director of the Center for Dairy Profitability at UW-Madison. He's an agricultural economist whose areas of specialty are dairy markets and policy. He's involved in applied research, including market assembly costs, processing costs, and efficiencies. He's also active in sector-level performance, including dairy policy and price forecasting. Thank you for speaking with us today. Before we begin with some questions, I'd just like to have an opportunity if you could all three share your videos for us so our attendees can see who will be talking today, if you don't mind, Paul, Mark, and Brenda. Thank you very much and welcome everyone. All right. I don't think we really voted on who would present today. Each of our panelists will share a brief presentation, but since Paul is unmuted, Professor Mitchell, if you would kick us off with a crop update for what you're anticipating for 2022, please.
Okay, I'm going to share my screen. I've put together a few slides here. Mostly, I think that'll go. All right. So welcome everyone, and thanks for the time here to speak. I'm not going to spend a lot of time. I want to kind of get into the discussion section, but briefly on 2021, I just want to point out how we've had a really good net farm income this year that we're forecasting. It's still not officially published yet by USDA, but it's well above our 20-year average. 2022, what we are interested in is costs are up. I think a lot of people know that for corn and soybeans. And I think this is a year, I'll let Brenda talk about the uncertainty on pricing, but I really think this is a year to put a price floor down to protect your margin. It looks like your margin, it's there. You just want to allow it, you want to keep it and then allow upside gains. And so one of these new tools we have that people might not have heard of much is SCO and ECO. I'll spend a little bit of time talking about those. It's a crop insurance option. And then lastly, I'll talk briefly about ARC and PLC. The sign up is going on now. I don't expect either to pay much, but it's just something to think about quick. You have to make that decision. So this is the data. USDA put this out on December 1st. You can see this is historical back the last 20 plus years. 2021 above our 20-year average, 19% above our 2020 farm income. This is for all farm income across all the different parts of agriculture. not just, Wisconsin or corn and soybeans, but it's 24% above our 20-year average. So 2020 and 2021 actually look like they're going to turn out to be fine years in terms of farm income on average for the average typical grower. Where's that money coming from? All of our commodities, our major ones, have had above average revenues this year. This is 2021 I'm talking about. 5-year high, corn and soybeans, well above average here. 2017 all the way through 2021 forecast. You can see the large jump on the left side there for corn and soybeans and revenues. On the livestock side on the right, it's beef is up, 5-year peak. Dairy is essentially flat. Broilers are up and hogs are up. I'll let Mark talk about what's going on in the dairy world, but you can see revenue came from corn and soybeans, cows, pigs, and chickens. But the real source of that gain beyond the high prices was this large influx of cash from the farm programs, particularly the MFP when 2020 still had some payments coming out, but CFAP, Coronavirus Food Assistance Program, CFAP 1 and 2, large pushing of cash into the farm economy to make sure the wheels didn't fall off the bus. I expect a major drop off in these for 2022. There's no MFP. CFAP is done. That finished up in October of 2021. The last 10 you could apply. And I really expect small ARC and PLC payments. The only thing we're going to get are conservation payments and maybe some from dairy. Again, I'll let Mark talk about that. So you can see way off the charts in terms of how much money the little for 2022, the little green for conservation will stay. And I really expect the ARC and PLC to be fairly minimal at the national level. So what are they doing with all this cash? This is a loan index from the Federal Reserve for the 7th district, which includes about the bottom 2/3 of Wisconsin, the southern 2/3. What are they doing with it? They're paying off debt. Index of loan repayment is the blue line. That's going up. Farmers have been paying off their debts, paying off those revolving lines of credit and such like that. And loan demand is down. You can really see how we've had a flip-flop from where it was a couple of years ago. All that extra cash is being used to pay down debt. Also buy land. Land prices are up. This is for 2021. This came out in August, but Wisconsin is up almost 11% is the national average. This is from USDA. You can get other numbers from the Federal Reserve Bank, has it even higher, up to 13% here in southern Wisconsin. Other states up more. Northern Wisconsin is in a different Federal Reserve district, and they had even as high as 20% increases. So land values are up. Depending on who you talk to, you hear different percentage increases. The other big thing is producer prices are up. This is the Federal Reserve System has the producer price index. This is an index of costs of production for all companies in the U.S. farm economy, not just agriculture. So it's the producer price index for all producers, companies making things. You can see it's been fairly flat since about 2010. I'll say 2011, 2012, fairly flat. It's constant cost of production roughly in terms of inflation. Then right there at the pandemic hit, that gray line on the far right, and then prices collapsed for a little bit, and then they've jumped way up, and you can see the numbers there. As of November 1st of 2021, we were up 22% before pre-pandemic as from January 2020. So this is a tremendous inflationary pressure pushing through the production side of the economy. Turning to 2022 now, this is crop budgets. I'm looking quickly at Northern Illinois, and then I'll look at Nebraska. You kind of get the sense here already. We can see the returns are up, but it's really on the cost side. Costs are definitely up. Illinois in August are predicting almost $700 for corn, almost $400 an acre for soybeans. That's the non-land costs. You have to add rent on top of that. Wisconsin's will be a little lower. Corn costs are up about 15%, soybean up about 8% for costs. There's still margins, still money to be made there. That's why I think it's important to preserve and lock in that margin of some sort of a price floor. Nebraska comes out here, and this is mid-October. They're projecting a cost increase of about 30% relative to 2021. So you can see tremendous inflationary pressure on the cost side, particularly for fertilizer we've heard, but you can see it's not just fertilizer, it's fuel, it's pesticides, seed, machinery costs, everything's up. The big one getting all the news is fertilizer. USDA NASS puts this price index out. Scott Geralt presented the figure for the prices back to 2010 at the Ag Outlook Forum, USDA's Ag Outlook Forum back in September. You can see ammonia and anhydrous. We can see that we've been climbing along, and then we're flat for several years here. Then we started climbing. This is back in September. And then I put the November prices there on the far right with the red arrows and the blue and the orange and gray dots. Anhydrous on November 4th was $1,200 a ton. DAP and ammonia or potash around $800. Then I just looked up the December 30th prices. The most recent ones, they're even higher. They're off the chart. I can't put $1,500 per ton on the chart there. It'd be up off the top of the figure here. December 30th prices were up to 24% from relative to November 4th. DAP and potash are only up 3 to 5% relative to November 4th, but tremendous upward pressure, particularly on fertilizer. That's one quick one. The other one is just talking about ARC and PLC. The sign up is going on now. It started back in before the first of the year. It got until March 15th. There's resources there. I've updated this page for this year. Some of the resources are the same. Then I made new stuff for the current year. Click on this, but right now my recommendations are laid out there. It's to sign up for ARC. If you're not doing any special crop insurance options, my recommendation is ARC, the county ARC, the agricultural revenue coverage. It's the county-based yield and rev price one, the revenue one at the county level. We expect high prices in 2022, well above the PLC reference prices that we'll look at here in a second. And so the only chance you have really of triggering payments is if the whole markets go to heck, which I'll let Brenda talk about that on corn and beans. But mostly, I think realistically, it's more likely to be in a pocket of this drought. This is the drought monitor from August 3rd, just to pick a random date. But you can see how there's pockets of drought last year. And I think that you can have a pocket of drought maybe in your county, or maybe a localized flood or hailstorms or something like that. It might cause your county yields to fall, but the national prices look to be solid. So for all these crops are that way, high prices relative to those reference prices. And so if you want to maximize your payments, sign up for ARC, but the reality is neither are likely to pay. I'm telling farmers, do not expect any government support this year from ARC or PLC, from MFP or CFAP. The only caveat to this signing up for ARC is if you want to buy this new policy called SCO, a supplemental coverage option, then you must sign up for PLC. You can wait until the March 15th. So you can go up, sign up today and sign up for ARC. And then come March 12th, you decide to buy SCO, you can then go back and with the USDA and change your election to PLC. These are the numbers here. Those are the reference prices on the left, 370, 840. On the right are the projected 2022 marketing year average prices for these commodities, corn and beans and wheat and oats. These are as of November 5th, is when the long run projections came out. Board of Trade corn is December corn is trading at around $5.50. November beans are trading around $13. So you can see these prices might be updated when the USDA comes out with their new long run projections here back in February. So the last point I really want to make is I think this is a year to think about protecting your margin. We've got some good prices, and yes, costs are up, but there's a chance to still make some money. And so you want to preserve that margin, but allow, in case things go haywire, to have some upside potential yet. These relatively new policies called SCO and ECO, supplemental coverage option and enhanced coverage option. They are crop insurance options. They go on top of your revenue protection program this year. And what they're doing is insuring part of your deductible with a county level policy. So a lot of farmers buy that 75% coverage. Maybe they're thinking about buying more to lock in a bigger margin to cover a larger chunk of the cost of production. Well, SCO and ECO cover part of that deductible, the first 25% of losses. SCO goes up to 86%, and then ECO goes up from 86 up to 95%. It's not you don't use your yield, you're using that county yield, but it's the same pricing and everything. And so you're buying coverage, you're layering individual coverage from revenue protection with ECO and SCO at the county level. And so you kind of have that mix of coverage, they call it layering. It's relatively new. About 6% of corn and soybean acres last year insured using SCO and ECO. So people are using it. And we don't know yet if it pays, but because we haven't had the county yields for 2021 yet, I don't expect it to pay unless you've had a low yield in your county. But people are really thinking about that this year, I think, and this is totally through crop insurance companies. If a farmer is interested, they should talk to the crop insurance companies to see Should I buy a higher level of crop insurance, maybe go up to 85%, or would it be better to do 75% or 70% coverage and buy one of these policies, the ECO or SCO, or maybe bring in a market, putting a put to something out of the money and putting a price floor on your crop. So high farm income in 2021, well above our long run averages. 2022 costs are up. There's still money to be made. Use a price floor to protect your margin somehow. Maybe look at SCO and ECO this year. The crop insurance companies are going to talk to farmers about it. So you might want to think about it yourself as a farmer. ARC and PLC, do not expect much for payments. If you're going to sign up for them, I would recommend ARC unless you want to buy SCO. SCO and ARC are very similar, so you can't do ARC and SCO. You have to sign up for PLC if you choose SCO. And so if you want to do SCO, you can change your mind at the last minute and switch your USDA FSA election from ARC to PLC and when you buy SCO. So I'm going to quit there. Thanks.
Thanks so much, Paul. So just a quick question for you, Paul. You know, you certainly talked about 2021 as well as 2020 just being unprecedented for farm income and the amount of government program payments. Can you maybe those farmers that are watching our live stream, can you maybe offer them some suggestions as to, you know, what to plan for in replace of that farm income without the government program payments in 2022?
Yeah, it's back to making money the old-fashioned way, growing stuff and selling it for high prices. That would be nice. And this is a year I think you can sell for high prices if things continue, you know, the way the markets are working. I think the bigger risk is to have the markets fall apart and you've got these high costs. A lot of people are seeing these high costs. I think banks are going to be willing, if you've got a solid balance sheet, to give you cash to do an operating loan. I mean, I'm sure they've all been in talking to their bankers already. It's the risk is if the markets fall apart. So I think you need to make sure you've got something to put a price floor down. That's what crop insurance helps with. You can add these other things, this ECO or SCO. They're going to be pushing that, I have a feeling, from the crop insurance company side. But there's also marketing mechanisms using puts, going with the put out of the money to protect yourself from grain markets falling apart. But don't give up the upside. I think if prices go, if we have a production issue, drought or something, that's on my mind is this low soil moisture going into 2022. Don't give up that upside margin. I think there's some opportunities possibly if things go haywire.
Great. Thanks so much, Paul. And
Sure.
just a reminder for those viewers who are on the live stream, if you do have questions for our speakers today, we certainly have a Q&A session, hopefully at the end of our hour. You have an opportunity to ask questions. You might need to click on the more button there on your screen to find that Google link to fill out those questions. So certainly take an opportunity to do that. So, all right, well, we'll see you back in a little bit, Paul. Thank you.
Excellent.
Now let's turn it over to Dr. Mark Stevenson, who's going to provide us kind of an update on the dairy side.
Thanks, Katie. Let me share my screen here if I can. And apparently I don't have, oh, there it is. I was going to say I didn't have the right to do that, but thanks. I want to talk about the outlook for dairy. We've had some number of factors that we're going to follow this year. We're going to look, first of all, at domestic demand for dairy. Then we'll look at what's been happening to the supply of milk. We'll look at export demands and export competition and a little bit of the friction that we've had in export opportunities with things like port congestion. So if we take a look at domestic demand for dairy, it's been good. We've had milk equivalent consumption across all dairy products up again this last year, even through the pandemic and the year before that. So consumption on a per capita basis of dairy products has been really pretty good. But during the time of COVID, we've had some product switching that's occurred. So in other words, it depended a little bit on where we're eating dairy products and as a result of what dairy products we're consuming. If we take a look at some of the dairy products that have been on long-term growth patterns like cheese, whether it's American cheese or other cheese, which includes mozzarella and Italian varieties, yogurt or butter, they've all been increasing in consumption, but cheese kind of took a breather during 2020. We did not have any kind of substantial growth in cheese, and that's been unusual for us because that's been a real star of the dairy industry over the last 30 years or more. Cheese consumption has been increasing, but we have increased other products. Butter consumption, of course, was up, and we actually had a little bit of a flourish for fluid milk. This is fluid milk sales, not per capita, but total sales. And if you look down there in 2020 through 2021, there was a bit of an uptick, and that was different than the longer term trend that we've had since 2010 of downward sales on fluid milk. So when people stayed at home, we bought extra milk at the grocery store and it was consumed. When we didn't go out to eat quite as much, we didn't have as much cheese being sold. Cheese is a prominently featured ingredient on out-of-home eating. So there was a little bit of this category switching that occurred. When we take a shift now to look at milk supply, our dairy cow numbers had been increasing for quite a period of time. You might recall that at the end of 2019, we had relatively good milk prices, and that stimulated dairy farms to be thinking about increasing milk production, which they began to do in the early first few months of 2020. And of course, COVID showed up, and on March 2020, you can see from there to April, the downturn in dairy cow numbers. That was when we had a lot of supply controls implemented, from co-ops to proprietary plants buying directly from farms that simply said, we can't handle the milk. So one of the responses was that dairy farmers began to cull the herd more heavily. Cow numbers declined, but by the time we got into June, we also saw some responses from government programs like Farm to Food Box, where cheese and other dairy products were being sought. And all of a sudden we needed more milk, so farms began to throw more cows on. And by the time we get into 2021, the red line up there, we hit a peak in dairy cow numbers that we haven't seen in many, many years. This was a large number of dairy cows and indicated a lot of capacity to produce milk. Now, we didn't have any more shutdown or mandates that just simply said, reduce your milk production. But frankly, Paul's high feed prices squeezed some margins pretty badly. And we had farms, even large operations in the West and Southwest, that sold cows and got out of business. So we have had a reduction in dairy cow numbers, and our capacity to produce milk is now less than it was a year ago. So dairy cow numbers have decreased. If you take a look at milk per cow, same kind of story. That purple line, of course, was 2020. That's showing you what happened to milk per cow. And in March, when we said slow down on milk production, it wasn't just cows that got culled. We also took our foot off the gas pedal, and we stopped pushing cows as hard, and our milk production per cow retreated. And to my great surprise, when we said, no, we actually need more milk, we began to get that through increased milk production per cow. And that has continued on through 2021, although you can see in the last 3 or 4 months that milk production per cow has softened quite a bit. Again, that's tight margins. It's expensive to purchase dairy feeds right now, and so farms are not pushing cows quite as hard as they otherwise might have. What this means is that we've had a lot of volatility in total milk production, but as of November's milk production report, we're actually below year earlier levels. So that below year earlier levels has given some real concern in the dairy industry about whether or not we're going to have enough dairy products in the year ahead. Here's where milk production has changed most recently. You'll see in the upper Midwest, we've still had some increases in milk production in a few of the states up there, and these are all large milk producing states. South Dakota is just going gangbusters, but we've lost milk production in much of the rest of the country, including the West, where we have states like California that have been down as much as 1.3%, and that's a large decline from our largest milk producing state. Export demand's been good. The blue line is showing you 12-month rolling average of milk solids as a percentage of the milk solids produced, total milk production, if you will. And you'll notice that that's been trending upwards since 2004. And this last year and recently, we've hit levels that we've never hit before. So we're exporting more dairy products than ever. If you take a look at what products we're exporting, this chart was showing you that we've exported quite a bit more skim milk powder and whey products. We've exported a bit more lactose and a few other products, but cheese is up. That's been a bit unusual for us. And butterfat, in the form mostly of butter, is up substantially from where it had been before, even though it's not a large number in general. If you take a look at who's buying those products, China has been a big buyer. Mexico has increased from the previous year rather substantially. They're our largest single customer. Southeast Asia is held in there pretty well, and other areas like the Middle East and North Africa and South America have all increased. So we've increased our sales to quite a few customers. If we look at our competitors for these world markets, those would be primarily New Zealand and the European Union. Also included in that is Argentina and Australia. In that dashed black line, you can see that the rest of our competitors have been flat to negative milk production. The red line is showing US, and that doesn't show those last negative numbers for November milk production, but we are negative too. So the entire suppliers for the world markets have tightened milk supplies rather considerably. The US not as much as our competitors. One of the frictions we've had in export has been port congestion. We've read about that kind of thing. Just to make it a little more graphic for you, prior to COVID and all the supply chain problems we've had, it used to cost about $3,000 to ship a container from Port of Los Angeles to, say, Shanghai. During COVID and at the worst of the congestion, that cost had risen to about $20,000. It's a little bit better now. It's dropped to about $12,000, and I expect it's going to continue to decline, but it's giving you a good indication that it's just harder to get products out of this country and where they need to go. Easier for us, for our countries like to Mexico and Canada, where we can ship actually by truck, but even there, you've read about and heard about the issues in just shipping over the road, that we simply don't have the drivers available that we have had in the past. One of the other frictions has been that the value of the US dollar against foreign currencies has been strengthening. You can see that in this graph. That vertical gray column was showing you the actual recession at the beginning of COVID. And there the US dollar was very strong, in no small part, not because we had problems or didn't have problems here, we did, but the US is kind of a safe harbor for other countries when the entire world is having problems. So there was a flight of investment in US dollars that gave strength to the US dollar. And recently, you'll notice on the right-hand side of the graph, the dollar has been strengthening. That makes our US goods look more expensive to foreign buyers, and it provides a little bit of headwind for trying to sell dairy products into these other countries. But our prices are competitive. This is showing you skim milk powder prices from major exporters. The US is the red line there at the bottom of the graph, and the European Union is the blue line, and Oceania is the green line. You'll notice that we're almost always at the lowest price of all of these export competitors. And that's because we export something like half of our skim milk powder that's produced in this country. So we have to be a competitive price all the time, and we are competitive there. Other products have not always been competitive. Cheese is certainly one of those items. Here in 2020, you can see the big price swings that we had from a low of about $1 a pound at the worst part of the safer at home in March, April of 2020. Or yeah, during that time period. And then the price shot up to about, $2.70 a pound. And we certainly aren't competitive there. But, since the latter part of 2020 and most of 2021, we've had cheese prices that are very competitive, and that's why we're selling more cheese into these world markets right now. We've added capacity for producing cheese in this country, and I think that that means that we are going to have to become a regular export competitor in this product category of cheese. That means that our cheese prices are probably less likely to be bouncing around in the future and more likely to be a regular export competitor. And, that can be a good thing for us if volatility diminishes a little bit. And it also means that we have something that's a bit more forecastable, I guess, or countable in terms of cheese prices. Butter prices, we're seldom competitive at, but we have been competitive in this past year. As these other countries have lost milk production, including the European Union and New Zealand, there's not been as much butter and butter fat items available in the marketplace in the world. US has been a little tight recently, but we have been a source of butter fat. And as long as we can be a regular source of butter fat, we can make the product that the rest of the world wants to buy, which is different than a standard US butter. It's going to be higher butter fat content, and it's going to be in different size packages than we normally produce here. But we can do that. And again, if we're going to be a regular supplier to world markets, then our butter prices are likely to be a bit more steady. I want to talk briefly about inflation. Clear on the right-hand side of the graph, you can see our last reports that have indicated that the consumer price index showed a 6.8% increase in inflation compared to the same month last year. That is an inflation rate which we haven't seen in more than 40 years. You have to go all the way back to the 1980s to find that kind of inflation. And, the real question is this a blip in time, a very short blip, or is this something that's more persistent? If it's a blip, and the Fed has been telling us that that may be the case until recently, now they're actually becoming concerned that this may be more persistent inflation. And that will have repercussions for all kinds of things, including dairy products. So, oftentimes our inflation has structural causes. 40 years ago, inflation was a cost push from high energy prices. The OPEC was formed by oil producing countries to short oil supplies and increase prices. Now, it certainly was successful in increasing prices. And that caused the government to do a few things like mandate automobiles become more efficient. And boy, we have done that. It was not unusual to have cars that got an average of 10 to 12 miles per gallon, back in the 1980s. And today, we're talking about cars with, high 20s to 30 miles per gallon, even for combustible engines. We also had the government incentives to insulate homes and save on energy there. Energy is at the base of everything that we build and we do. And so when that's the case and those prices go up, then we tend to get inflation across the board. Today, it's not energy so much, even though energy prices have been up a little bit. I think that the cost push today is really coming from labor shortage. We've had such things as pandemic-inspired job changes. People who simply said, you know what, I can get a job anywhere right now, and I'm tired of my old job, so I'm just going to change. And that's been happening. We have found couples with kids who have said, it doesn't make sense for us to have dual income in our family. One person is going to stay home and watch the kids and take care of the house and that type of thing. We've also seen baby boomers who are just deciding that this is too much. I'm going to retire shortly anyway. I'm deciding that I'm going to retire earlier than in the past. All of these things would have happened without the pandemic. They are just demographics that we've been seeing, but they've happened sooner and they've happened all at the same time. And that's given rise to wage increases and labor prices that have gone up considerably for folks. Labor is also at the base of everything we build and everything that we do. So it has the possibility of really giving us a cost push into inflation. What I would tell farms to do is to look at and think about their capital investments. Fiscal policy can be a cause of inflation, but it's never a solution. And quite often we do find inflation that happens because of wars and big spending that occurs. Maybe today we can say that some of the spending that's occurred as a result of COVID, for things like stimulus checks, it could also be inflationary. Monetary policy, on the other hand, what the Fed does is always the solution to inflation. And so I think we need to be watching interest rates. There's certainly talk about those creeping up. We're beginning to see that. But for farms that are highly leveraged, if they aren't being a little bit careful to lock in interest rates, then we could see some of that becoming a significant cost to dairy farms again. If you're thinking about capital purchases and maybe toward the end of the year, you actually find some cash available this next year, I'm expecting much better prices for us. Look at evaluating your capital purchase as a return on investment, not asset values. Because 40 years ago, we did quite a bit of buying of capital assets just based on the notion that those assets were going to appreciate in value, not depreciate. And since this labor shortage is real and impacting agriculture and farms, and probably long lasting, I think that investments that are targeted toward labor savings would make the most sense. Think about things like automated milking, feed pushing, etc. John Deere just announced the large-scale rollout of tractors that are fully autonomous, and field equipment we're rushing to automate as well. Those are the kind of investments that I think will make the most sense to be sure to cut down on some of your operating costs of production. So here are my forecasts for prices. If you take a look at that green line and clear out on the right-hand side, it is a dashed line. Those are my forecasts. They're well up this next year and relatively flat. We could see volatility, but right now forecasts are for being relatively flat. And I'm looking at something like a $22 average all milk price. So that's much better than the less than $21 average price that we've seen for 2021. And really potentially a fairly good price, even given inflationary costs for farmers. In summary, domestic demand's good, product shifting, but it's been moving rather steadily. Domestic supply, things are a little tight right now, and we've certainly seen that action or activity in futures markets in the last few days. People getting concerned about whether they can secure their flush supply of products for this next fall, particularly in the West, where a lot of butter and powder are made, and that's where much of our exports come from. Export demand has been strong across all product categories. The competition is less milk from the EU and New Zealand, so we've got opportunity out there. There is some friction, but the port congestion is getting better. Prices are competitive. I think we're going to pick up market share. And finally, I think inflation is a big unknown. We better keep our eyes on our investments, be cautious, but absolutely think about putting a floor under some of these price opportunities. Right now we're seeing some $21, $22 class prices for milk. It's not a bad time to be thinking about putting a floor under there. I would also say buy your DMC. That product is open right now. And if you haven't signed up for it yet, do that. I think there's a low probability of payout on it, but at 15 cents a hundredweight for tier one at the 950 level of protection, buy all of that you can. That is cheap insurance. Milk prices are pretty good, but continue to look for those risk management options and control variable costs. And with that, I'm done.
Well, thank you, Mark. This all makes sense to me. Export, import, fiscal, and monetary policy, but you and the panelists are all economists. So what about, for example, a farmer in Dunn County who, hears that, hey, milk price is going to be $22 potentially for 2022. And, you talk about investments. Do you have any suggestions for that farmer? Should that farmer consider increasing herd size, milk per cow focusing on, or should they first talk to their processing facility?
Oh, without question, Katie, they should talk to their milk handler, processing facility or co-op. Can you take more milk? Do you want more milk? Because I certainly wouldn't encourage people to be pouring concrete without first checking for that. That is the existential question of whether the plant wants my milk and can take it. If they do, I want to supply it for them. That high price is a market giving us a signal that says they want my milk. And so it's fine to be asking those questions, but I wouldn't make a capital investment in producing more milk until I knew for sure that I had a market for it.
Definitely. So do you have other suggestions of what they can do to increase their farm income, especially as Dr. Mitchell talked about, replacing some of those government program payments within their income that they might have received in the past couple of years?
Well, again, Paul certainly gave the example of protect some of that income. And I'm looking at these prices right now, and I'm saying these are excellent prices. We haven't seen these since back in 2014. So this is a very good time to be going in and trying to tuck a floor under some of that stuff. Now, give yourself some upside potential to the prices for sure, and hopefully they all hold over this time period. But certainly protect a portion of that milk supply. If you've got cash and you've got some money that you are going to spend, you could certainly buy down debt if you're heavily in debt. But if that's not your big issue out here, then think about spending it on productive assets. And those, I would say, look at labor saving devices, because that not only provides you the potential for greater milk production per cow, for example, in automated milking, but it also reduces the operating costs of production. Now, you need to use those facilities carefully and you think about it, but it's a real possibility. It's not questionable technology at this point in time. It's well proven.
Great. Well, thank you for that. And we'll revisit with Dr. Stevenson towards the end of our hour. Reminder, if you're listening to our live stream, you have an opportunity to fill out the Google form and ask questions there. And we'll address those towards, again, at the end of our hour here. So our final speaker of the day is Dr. Brenda Botel, and she'll be sharing her grain market outlook. Go ahead, Brenda.
All right, so let's just talk about the grain markets kind of quick. Basically, a lot of the same things that have been impacting grain markets, we've talked about. Inflation's a big impact. Exports are a big impact. Those are the two biggest things that are having big impacts right now. Mark, a lot of those issues that Mark discussed with the dairy side carry over then basically into the grain markets. When we're looking at, port congestion or inflation, all of that's still having that impact there. So I won't spend time talking about that because Mark did that pretty well. And so I'm just going to kind of talk about like where we're at right now with the grain markets and what we kind of expect to see this spring as you're looking at your planting intentions and then, what might happen afterwards. All right. So give me 1 second. It's not moving. All right. World ending stocks. So let's talk about soybeans first really quick. I'm only going to talk about soybeans and corn, just given some time here. World ending stocks, this is basically the data that we have from last month's WASDA report, which you are probably aware. It will be coming out then again next week with new data. Remember, the January reports for WASDA is basically where the USDA makes any or makes their final revisions on the supply side typically for the year. So that would be if they're going to make any changes again to the acres that are planted or anything like that, we'll start to see that in this January report. On What we did see with the December, there haven't been any changes in the November and December. And on the world ending stocks, basically what we saw is we're up. Basically, they're saying our ending stocks of soybeans are up about 2.1% from what they were at in December of 2020. I do expect we'll see some changes more than likely on this world ending stock side for the January report, primarily because of Argentina and Brazil. So when we look at that, looking at a lot of the private analysts, previously in the WASDE report, they had Brazil being at 144 million metric tons for their production basically this year. Most private analysts have cut that now, just given the weather situations that they're seeing in Brazil. And they're saying it's going to be about 135 realistically. So the USDA will probably see some decline in that, whether or not we see the total amount of that, because that's still an estimate from private analysts, but they'll probably start to decline that a little bit. If we end up seeing that, that's going to end up playing into and helping somewhat soybeans in the US, because that's going to be a lot less competition, particularly come March, if we start seeing lower production in Brazil and Argentina. So let's talk about the soybeans then basically in the US. The two biggest things, I didn't put up the WASDE reports because we'll see the spreadsheets or the balance sheet there. The two main uses that we'll see that the US reports in the WASDE report are for crush and exports. As I said, I don't really see if they make any changes on the supply side for US production. I think they'll be minimal. I don't really see big amounts of changes that they're going to make. They might, typically you might get a little bit there, but it probably won't have huge impacts. Where we're looking at now then, and particularly after the January report, they'll start to focus on the demand side. One of the big things and what's been leading a big chunk of soybean prices is the crush. When we look at soybean meal and soybean oil, those are really soybean meal historically for the last couple of weeks has been leading the charge there and helping basically keep that the demand for the soybean meal has been keeping those prices high and keeping basically the expectation and that crush levels as high. As we start to see, that more hawkish types of Federal Reserve, and we start to see the expectations and that interest rates are going to rise, that's going to have an impact then on all raw materials and demands in that. And so that essentially, if we start to see that's going to put some pressure on the soybean meal and soybean oil, which will then eventually put pressure on soybeans. At the current time, though, crush is really strong, and that's really helping basically keep those soybean prices. We've had record crushes here in October and November, and those are translating basically over into huge demand for soybeans. All right, so the biggest thing that we have to watch on this side going into this next year is it that interest rates, is that going to play into having a big impact on demand for meal and oil, which will then impact crush margins. All right, so that's one thing we want to look at. Currently, though, it's still really strong. When we're looking at, exports from soybeans, both corn and soybean, when we entered into the 2021-22 marketing year, we entered into it with relatively large quantities of committed exports. So they carried over from last year's, all right, where they committed and didn't buy them in the last marketing year. All right, so following those early sale commitments, then if we look at that, on exports for soybeans, we've tracked fairly closely with historical performance. All right, where we're seeing though is actual sales and accumulated export shipments. If we keep that, we're going to be okay. We're going to be right on target and potentially exceed slightly above the WASDE projected levels. Where we're starting to see some issue is in actual shipments, though, of soybeans. And so, at the beginning of the year, they moved faster than what we have done in historical times. But now we're starting a little bit slower, and we're starting to see a lot of that slowing of those shipments. And it's a little bit concerning because that's starting earlier than what we would typically see. We don't typically see that slowing until March when the South Americans come on. Now, again, if we end up with weather problems or a lot shorter of a production than what we were expecting, that's going to help and keeps exports coming from and out of the US. But this is playing into a weather market still, and it's not weather here, it's a lot weather, obviously, as this time of year of what's happening in South America. So from a soybean perspective, what are our factors here? On the bullish side, when we look at the prices, what's going to happen, that crush remains strong. And I don't see it just dropping off really, really quickly. However, if we have those interest rates and that plays into that, that could play a factor. All right, so the crush is still remaining strong. Bullish wise, though, news wise, the market's that's going to keep those prices a little high or going higher is that Brazil's dry. And they're going to see lower yields. How low they go is going to be a little bit dependent, but if they keep this level and they keep slashing their production estimates, that's going to keep those soybean prices high. All right. The other thing that we have that's a bullish factor for soybeans is the prices. Paul talked about fertilizer prices. Now, obviously, fertilizer prices have a greater impact on corn than they do on soybeans. They impact both, but from a relative level, they're more impactful for corn prices. But because of that, then you have to keep that corn price high to help to cover some of those costs of production costs. And if that corn price is remaining high, that's going to lead and give pressure for soybeans to remain high, particularly until we are planted. All right. So for the first part of this year, as long as those things are staying high, that's going to keep those prices a little bit up. Bearish side where we're at is the exports. So as I said, we came in with the long stop. We've got the potential to be able to meet the USDA expectations and projections. But if we start seeing shipments drop off significantly more than what they are, then that's going to be a concerning factor. One thing that we look at, export sales, yes, they're down year over year, but remember last year they were extremely high. And a big chunk of that was because of China. China is basically at this point holding out on any of their sales, and they're waiting for the Brazilian bean market. So again, this is going to really play into if we don't have as much beans coming out of Brazil, then that's going to bring China a lot more back to the US. So the other thing when we think about from soybeans and where they're going to go for the first part of the year, markets, we get a lot of just investors and non-commercials into the soybeans and the corn market, and that for the futures contract. Right now, they've been trading sideways. And when you look at the news in that, basically in order for prices to continue to keep going up, you have to have new news. When you have no news, that tends to bring about, just from a technical point, a bearish tendency. So because they've been trading sideways until we get new news that really indicates it, news that hasn't already been built into this, that's the idea that we could see prices start to drop a little bit. Then we couple in that with when we look at technical factors. So this is just, again, momentum. This has nothing to do with the fundamentals of the supply and the demand of soybeans. It's just what is happening here with the prices. As an investor and non-commercial, I'm going to look at those. And technically right now we see that soybean futures are overbought. So if that is the case and those investors start getting worried about that, and there's no new news to indicate that prices should stay high, then you're going to see the prices drop. And because of the amounts that we have in some of these, in particularly corn, we could see that drop relatively quickly. All right. So where are we going in 2022? I think personally, the prices are going to continue to increase until March, just because we have the seasonal components that we have there. We have the strong crush. I don't think we're going to see we'll see probably some slight increases in interest rates in March. But I don't think we'll see much impacting some of big changes wholesale until that time frame. Plus, additionally, at the end of March, we get the planting intentions. Then that's going to be the big indicator of what could potentially happen between corn and soybeans. because there's a big battle for whether or not the acres are going to be in corn or soybeans. And it's really dependent on what is your land, whether you've already pre-invested and have your fertilizer already there. So when you talk to a lot of producers, if they've already been able to do some fall fertilizing, or they have it locked in for fertilizers, then they're not being so concerned about it. Otherwise, they're looking at, am I going to have to make some switches between my corn and soybean acres? So there's a lot going on here. And by March, we're going to have a bigger indication of that. And that planting intentions, realistically, it's January now, so it's really hard to say what's going to come out in March. But I suspect unless we get something really solid here, and I don't think that's going to be the case because there's so much variability on land yield, fertilizer costs, that we're going to end up seeing that intention is probably not in the range of where those pre-estimates are going to be. There's going to be a bigger range there. So there's some potential after March, depending on what it says, that the market's really going to be very volatile. When we look at corn, the biggest thing, you guys know the soybeans, I've had the chart there too. Corn price, when you look at it compared to where we were at last year, corn prices are up 38%. They're up 28% for soybeans relative to last year. We've had this big surge in prices. A lot of this, even though we've had strong demand, even though there's been other issues here, it is truly demand driven. All right. When we look at the big demand parts for corn, again, the three big ones are feed and residual, corn exports, and ethanol production. I'm just going to talk about corn exports and ethanol production. But when we look at corn exports again, we've seen strong amounts of export sales. So even without China, which was a big indicator last year, we're running above the pace that's needed to meet the USDA projections. All right. So those are the sales. Those are our commitments. Those sales in this case need to average, if we're going to continue that, at 25 million bushels in order to be able to reach that, which is that yellow down at the bottom there. So that's below what we've been doing. On the other hand, shipments aren't as rosy. So you can commit to buy this, right? And we track that. Then the next thing we do is we track what are the actual amounts that are being shipped and what is being inspected. And that's down. So year over year, we're down 15% from a year ago because, again, we're back on this whole issue of shipments are just so delayed. So if we can get them out, we're going to be okay. If we can't get the shipments out, we can't get these inspections out, then basically if we keep at this pace, we are not going to meet the USDA projection, and we'll end up seeing that revised downward because we won't use as much corn as what we're expecting to do. So people want it, we just can't get it there. That's the biggest issue that we're seeing right now with our exports. When we look at ethanol productions in the last couple of months, we've been breaking records. A lot of it also on some very robust margins for ethanol and very high demand for ethanol. All right, so we've been looking at this. We had a record high in December, basically, compared to the last time where we were that high was in 2017. Currently, those weekly production estimates indicate that we're going to bypass, if we keep going on this, any of the previous records. All right, when we look at the margins, they're very strong. They've fallen in the last couple of weeks, but they're still very strong, and they're still way above. If we continue at the crush what we're at, we are still significantly higher than what we would need for corn to be able to meet the 5.25 billion bushels projection of corn usage for ethanol. So this is really helping support corn prices here right now. The one little concern that we have, and if you can see the little charts right here at the bottom, is that basically when we're looking at our, that's the bearish part, is that we've started to build some stocks up of ethanol. They've been rising in the last couple of about 3%. And then we've also seen gasoline demand in the last week or so plunging in the demand's tapered off for gasoline in the last little bit. So that's going down. We kind of get into this period where we don't use as much. And with those stocks, That's going to tie into those margins a little bit. So we'll start to see that production going down some, but still, I don't think we're anywhere near the point where we aren't going to meet the USDA expectations. All right. So now bullish factors for corn, ethanol demand's there. You know, as long as we keep having high gas prices, as long as people still want to keep driving, we're going to see that, and we've got it. Feed usage, I didn't talk about it. That's helping quite a bit as well on it. You know, when we look at gas prices, they're making ethanol more profitable. The other thing that we've got for bullish factors is that cost of production. Now, again, as I said, when we look at it, cost of production, just direct costs for corn production between this year and last year, it's up 25% for corn. And the majority of that increase is coming from fertilizer costs. So that is being somewhat built into it because of the expectations here in order to be able to keep people and entice people to plant corn this spring. Now, the other is seasonally, we typically will see price increases until now in May. I don't see anything that should say that we should go counter seasonal. So I do think corn prices are going to continue to go up. The bearish factors that we have are exports. If there's any big news on exports, that's a big concern. Technically, again, corn's overbought. So if you start to get a lot of these non-commercials that get very concerned and they get an exit out, then again, those prices are going to drop. There is nothing in the fundamentals that warrants $6 corn right now. We have enough stocks. We have enough of this. And right now, the feeling is that even though we'll have less acres planted in 2022, they're not going to be down so much that we're going to be extremely short next year. So right now, there really is nothing there. It is truly just the market that's keeping these prices here, not the fundamentals. That means it's going to go down. All right. I don't think that's going to happen until March, because I think until we have more secure feelings of what's being planted, that corn price is going to stay high. All right. Just to entice those acres. So where is it going to go in 2022? You know, this is just now, not talking about the crop that you're going to plant in, you know, the spring. Where's the old crops going to go? We're already above projected USDA annual average price. All right, so we're there and we're at a comfortable level. I do think it's going to adjust seasonally through March, going upwards. There's still limited upside potential just because of the seasonality component. But as I said, the fundamentals don't support that $6 price. So the downside risk is limited until we know those acres. But once we have a feeling of those acres for projections in March, we'll start to see that going down. All right. So I would be looking at this. I would be paying attention to that. When we look at the soybean to corn ratio, so typically we think about this line right here. Anything above that's favoring basically soybeans. Anything below it is favoring corn. All right. Just because of the way in which this pencils out. With the increases basically of the fertilizer costs and having a bigger impact on corn than it does on soybeans, that this line doesn't hold quite as true, and it's going to be down here a little bit more. When you look at a lot of these budgets that are put out, and if I've done my budgets too, right now corn, even with not with the $1,500, but when I look at this and I have mine direct costs, all right, so this is with fertilizer increases as of November prices, we were still penciling out better for corn acres with 174 bushel average than you were with soybeans at 51 bushel average for those soybeans. So there's not this huge impact for the switch that some people were indicating previously, expectations. Where are they going to go? I think you'll still see some. So I think you'll still see an increase in acres up about 2.3 million acres. You know, if you look at this, you get the average national yield of 52 bushel or trendline yield, of 52 bushel acres. Where would we be at? This would be the average cash price for the marketing year 23. So this would be this is not your harvest price. This is the average price. It could be anywhere from $9 to $10, which is significantly lower than what you're seeing this year, which is $12.10. All right, but this isn't until this is a what this is where we're looking at it for here. If we have that many acres, if we have 90 million acres of corn planted, so this is 3.3 million acres than what we had, less than what we planted in 21. We have that trend line yield of 177. Basically, we're going to look at average cash prices then that are going to be in that $4.50 to $5.20. All right. I guess I didn't even realize this was on there. My apologies. So you're going to see that idea there. This year is going to be, as Paul was saying, this year we're going to have cash prices. Is it profitable? It's still profitable. Next year should still be profitable, even with some of those higher, because even though we're getting decreases, we should still be able to see that as a profitability if you get those trend line yields. What are you looking at as far as for marketing? Soybeans, assuming you probably have quite a bit of this harvested already. So 2021 harvest, you're about 75% sold. If you haven't sold that, if you're still holding on to more than that, I'd probably be looking at trying to get that sold. All right, I'd hold on to what you have left then, at least for a short while, because I don't think you're going to see a significant drop in prices, or yes, there'll be volatility, but it won't be significant for a couple of months. So I'd be looking at this carefully. By the 1st of March, you've really wanted to take a look at what the market is and what's going on. All right, but I wouldn't do anything yet. I'd hold until February. If you're looking at 2022 harvest sales, sometimes like last year, I was indicating maybe doing some forward contracting or puts to lock in your harvest price already. I wouldn't do anything yet because I do think prices are going to continue to increase for a short period of time, but you'll want to be looking at that. And I would start for sure to be looking at that, seriously doing a small percentage of that, like as Paul was saying, doing something before, like around the 1st of March, before you've got some of those planting intentions. All right. So, because again, if that planting intention report comes out and it's not what the market's seeing, you're going to see huge volatility at that point. For corn, again, you probably got quite a bit of it sold. So let's say you have 75% of it sold. I would hold on to anything that you have left yet. I wouldn't be pricing it yet or holding it. I'd still again wait for another month or so. And look at it this way. And I'd still also wait for any of the contracts for harvest. I wouldn't do anything until February. You are going to want to eventually do some types of forward contracting for soybeans and corn. So for this harvest, as Paul was pointing out, you're probably not going to see the government monies that we saw early to rely on, but and the prices here are probably going to be highest now up until March. All right. I do think they're still going to increase. That's why I'm saying hold out just a little bit yet, but I would be looking very carefully to make sure you do some types of forward contracting on those, get a small percentage of them done by March, and then continue to watch the market through May. All right. If you have questions or not, let me know. Otherwise, I will stop sharing, and then I think I'll stop sharing. And we can go back to here.
All right. Thanks so much, Brenda. We went over just a little bit on time, but it was such good information. And you answered my questions that I have about 2022, 2023 going forward, as well as some of that marketing strategies. So if people do have questions, I'm sure they can reach out to you. We did not receive any questions on the Google form, but and I know Brenda did not have time. She always also likes to provide a livestock and meat outlook. And so you will be providing that at the 2022 Wisconsin Agricultural Outlook Forum on January 25th. And that will be live streamed for those of us like me who don't want to drive the couple hours to Madison. So I look forward to her presentation there on livestock and meat. With that, I want to thank Dr. Botel, Dr. Stevenson, and Dr. Mitchell for joining us today on our Farm Management Friday webinar series. And I will turn it over to our program manager, Tricia Wagner.
Thanks. Once again, want to thank Katie and a panelist and all of you for joining us for today's Farm Management Friday Farmgate Economic Outlook. Again, in the description to this video on your screen, you'll find a link to a short 3-question evaluation survey. We really appreciate your feedback and learning about what you will do with the information shared in this program. For those of you that are pre-registered for the event, you will receive an email as well with a link to the evaluation. So that's it for today, but join us for our next program on Friday, January 21st. That webinar will focus on the new Farm Pulse program. The Farm Pulse program provides a framework for informed decision-making to make sense of financial information, so you know how to start managing your farm finances. In addition to a focus on financial management this month, our February programs can also be found at the Farm Ready Research website. February programs will focus on farm labor and employee management skills. So find more Farm Management Friday program details and registration at go.wisc.edu/farmreadyresearch. Thank you. I hope your new year is off to a great start. Have a nice rest of your Friday and stay warm.